Okay, thank you. Hi, everyone. Welcome. Thanks so much for joining us for today's Accounting Design Project Workshop. My name is Natalie Burfeld. I'm an assistant professor at Boston College, and I will be moderating today's talk. We're very, very happy to have Stephen Penman here from Columbia Business School to talk to us about accounting for carbon. Before we start with the talk, I just want to kind of go over and remind just a few general rules. We're going to reserve the first 5 minutes for uninterrupted. So please let Stephen talk for 5 minutes. And then after that, if you have questions or comments, please use the raise your hand feature in Zoom or the chat box, and I will call your name in order. In the interim, when you're not speaking, please mute your microphone. That will help us reduce background noises. And we also encourage you to please turn on your camera so that we can all stay as engaged as possible. So without further ado, let's welcome Stephen. Please, the floor is yours.
Thank you very much, Natalie, and thank you for those who are attending. As the paper tells you on the screen, the title here is Accounting for Carbon. I think this paper very much fits into the Accounting Design Project agenda because it is purely an accounting design paper. Okay, you're not going to find any hypothesis testing here, so in that sense, it's not the typical research paper we see. It's just my ideas from reading and a little bit of help from Stefan Reichelstein to come up with a design for how to report on an entity's responsibility for dealing with carbon. I've got a funny story to tell you. I think it's a funny story to start with. I submitted this paper to the Accounting Review some time ago. Actually, prematurely, I should have submitted that early. The managing editor, the top person, came back and rejected it. And the reason was there's no hypothesis testing. There's no t-statistic. In fact, I was actually quite amused by this because I always thought our mission was to design accounting, develop better accounting. And this is strictly a paper that does that. Of course, that means we go through a lot of scientific endeavor testing hypotheses, but that was the opinion of the journal. I don't usually write back to editors when I get rejected, as I sort of regularly do. But this time I did. I wrote back and said, so I understand that you would have rejected Pacioli if you'd submitted it to the Accounting Review, which I thought was a very cute thing to say. But if you get my point, okay, our mission and the mission of this accounting design project is to design good accounting. And sometimes that does not involve hypothesis testing, although there's going to be a lot of theory and a lot of hypothesis testing on the road to doing this. I was disappointed because what do I say to young people? Don't do this sort of stuff. You won't get published. And that is very, very distressing. Okay, so now with my complaint about being rejected, like we all have our complaints about being rejected, I will proceed. Okay, what's involved with the accounting for carbon now? Well, not much. We have some measurements. We have the CGH protocols, which says that there's 3 types of measurements. There's scope 1, scope 2, and scope 3. I won't go into that. I presume you know something about these different scopes. But it's not organized in any way. It's just measurements that are pumped out regularly in what you might call as a flow number. This is the amount of net scope 1, scope 2, and scope 3 for which the entity is associated with. What complements that, and I think most of the regulation, is disclosure. The International Accounting Standards Board with their E1 and E2, all these European organizations, I don't even know what they stand for here, it's disclosure. We're not going to do accounting. We're not going to do disclosure. We're going to do disclosure. Now, usually when we think about it, we think we have disclosure when the accounting is not sufficient. The first order is to get some counting going. And if that is not sufficient, then when we think about disclosure remedy. So the question is, can we develop accounting that is up to the task? Well, what does the current accounting system do? Well, inherently, if you want to think about it in terms of financial statements, there is an income statement, a flow statement, where these three types of emissions, scope 1, scope 2, and 3, are the emissions which are recorded. And against that is netted any carbon credits. So an entity reports its net carbon emissions for the period. There's a sort of a flow statement, if you can imagine it. Where's the balance sheet? Well, this is not a mistake. This is a blank page because there's no balance sheet. And an accounting system has a balance sheet and an income statement. And so the question is whether we can get an accounting system going which has both a balance sheet and an income statement. Now, in accounting, we have basically two broad accounting systems. We have the financial accounting system, and we have the managerial accounting system. And the question is, therefore, when we're thinking about this, can we take the accounting in those systems and apply it to accounting for carbon? And the answer is yes. Indeed, significant work has been done on the managerial application. The managerial application says, just as in managerial accounting or cost accounting, we accumulate costs in inventory, which then go to cost of goods sold in a flow statement. So we can accumulate the carbon content of products. The two major contributions I know of are the Kaplan-Romana e-liability system, whereby they track from the cradle to the grave, cradle to the gate, as they call it, the amount of carbon that's in products. So when you come to buy a car, it reports you, this is the amount of carbon that was generated in the production of this car, all the way from the mining of the raw materials, all the way through the production progress into the end product. And so you get a number similar to cost of goods sold, okay, which then tells you what the carbon content is. That seems to be very good accounting to me. Stefan Reichelstein has embellished on the Kaplan-Romana setup by introducing a balance sheet. So there are assets and liabilities in the system. And it's closer to a double entry system than the original Kaplan-Romana work. And what happens there is the assets are deemed to be accumulated costs. Here are the costs coming in with the plant you produce, with the materials that come in and so on. And we accumulate, he accumulates those costs. And as they go out the door, out the gate, then those accumulated costs in the balance sheet are transferred to a quasi cost of goods sold number, which is not dollars now, it's the amount of carbon in the product. Do I have it right, basically, Stefan?
Since you're calling on me, okay, I'm not sure the time is up that we can.
Just give me yes or no, whether I'm screwing up here or not, please.
Almost. I wouldn't call at least what I have written about strictly a managerial application or managerial accounting application. I would agree that the workhorse in this accounting system is the product carbon footprint, like inventory costing.
Yes.
But my idea is that you go further and basically express the corporate carbon footprint as a flow measure, the emissions that the company signs responsible for in the current period. That is then basically obtained as the aggregate of the individual product carbon footprints of the goods sold.
Yes, okay. Yeah? So it aggregates over the products for the whole entity. Okay, so that's all I'm going to talk about, because what I'm going to talk about is how now we can take the financial accounting system to, rather than the cost accounting system, two products. So if I take the financial accounting system to the accounting for carbon. And the financial accounting system is a system of balance sheets and income statements of accounting for an entity, okay? And so the focus here is really on entity accounting rather than product accounting. It's on the accounting for carbon for the entity. What is with a balance sheet? What is the entity's net position in carbon, and what are its annual flows? Okay, and what we're going to see is actually this is not going to be very difficult to understand for all of you who are familiar with financial accounting, because the principles that apply here are very similar to the principles of financial accounting. There's only two things that differ. One is the unit of account. It's the same structure, income statements and balance sheet, same accounting principles, but the only thing that differs is the unit of account. It's CO2 emissions or CO2 equivalent emissions with non-CO2 emissions weighted in rather than dollars. But secondly, and this is very important, you've got a different stakeholder to whom you're reporting, okay? You're reporting to not to shareholders as in financial accounting. You're reporting to a different constituency. And so broadly speaking, what you're doing is you're going to take these GHC protocols and put them into an orderly system. Let's call them accounts.
Paul has a question.
And then we're going to use that as reporting. Hello, Paul.
Hi, Steve. So this is fascinating. I just have a question. The question going through my mind, you answered in the third bullet that it's not dollars, it's some unit of CO2 emissions. So when I think of a standard dollar accounting system, the accumulation of profits goes into retained earnings, and the more of that you have is a good thing. But my intuition is telling me that the more your footprint here is a negative thing, that you have too much. Am I right, or am I going wrong?
Maybe you just wait till I get to how we think about shareholders' equity. Okay, no.
Okay.
Now, the higher the shareholders' equity is better. The lower the shareholders' equity, the worse. Okay.
Okay. All right.
So that'll turn up.
Okay.
And that gets into the other issue, the question of to whom we are reporting.
Sudipta also has a question.
Sudipta's here. Okay, here you go.
So you mentioned the financial and managerial accounting systems, but we also have a tax accounting system. And for something that is being regulated, so it's not market-based, but it's really regulatory prices or quasi prices or whatever it is, I'm wondering why you think that the financial accounting system would be better. So do we need something different than sort of market pricing? Because that's what the financial accounting system is based on. And do we need different verification for different things? Because, the tax system is more conservative because you tend to do stuff. So I'm just wondering why you picked financial other than
well, the tax accounting, in my mind, the tax accounting is something that is actually developed or imposed by the legislature or the politicians, okay? And there's all sorts of criteria. If you want to think about it this way, I haven't really thought about having a tax accounting system. You want to think this is a tax accounting system, okay? But then you can go on, as you do with the financial tax accounting systems, you go and modify it if you want to do different things, okay? Have different incentives, treat things differently. This may be a starting point for a tax accounting system, because it's about, now, if you want to tax emissions, it's information that gives you a number to base that information to base that on. Okay, so okay, so
sorry, Jonathan also has a
Jonathan, there you go.
I was surprised by your answer in the sense that, I thought the whole point to your shareholders' equity was going to be a multi-stakeholder view. A tax accounting system sounds like it's designed to achieve a tax objective. It just sounds like a different mindset. Anyway, maybe I should wait for you to talk about shareholders' equity, but it seems like, the multi-stakeholder view leads to something closer to what you're proposing than a tax accounting system.
Okay, I'm not quite sure what you're getting at there, but again, come back at me if once we get this this stakeholder established, okay? Which is actually very important to understand to get to grasp what's going on in the system here. So in the financial accounting system, of course, we have assets, liabilities, with the difference is the shareholders' interest. Assets are those things that project the future, okay? And so what we're looking for here is assets which actually project the future, namely the future firms' future efforts to reduce carbon. So think about a firm making investment in on the top of a chimney stack to reduce carbon in the future. This is an investment measured in expected CO2 units of what they to reduce carbon in the future. So you have an asset here, which is something which projects the future carbon remission. And you got liabilities, of course, from liabilities to clean up in the future. Okay, and the difference is the shareholders' interest. Now, financial accounting systems, we have an income statement, which is revenue minus expenses, benefits minus the cost to get the benefits. We have a net benefit. Okay, so our carbon, we want a carbon statement, income statement, so-called, which is going to indicate that periodic net benefit. So that's the aim of what we're trying to do here. Okay. Now, in the financial accounting system, as we bring these two things together, we have an articulation. We have an income articulation of the balance sheet and income statement. That is the periodic addition to the shareholders' wealth, if I can use that word, is added to beginning equity to give you the closing equity. Net dividends, of course, are paid out of that. So that, of course, is the well-trodden clean surplus equation, which articulates. But we have another feature which we want to preserve as we go to accounting for carbon, is that the closing equity also equals assets and minus liabilities. What we're talking about here is double entry. The first equation is an operational equation, a clean surplus equation. Start with beginning book value, calculate the earnings, and close in the closing entry, close it to the shareholders' equity. But in doing that, you're going to maintain a relation which is that equity is equal to assets minus liabilities, which just says that you cannot affect the income statement without affecting either an asset or liability. Okay. And that's the double entry aspect of accounting. And that we want to preserve. And we'll indicate the reasons why we want to preserve that. Now I'm going to flash to you the balance sheet, okay, and the income statement, and come back to it in more detail a little later after I talk more about the features of the system. You see there are a list of assets that are recorded for the entity. Carbon credits purchase of an asset, investment to reduce carbon in the future, investments to avoid carbon in the future. These are all assets. And similarly, there are liabilities. Okay, if you sell carbon credits, you've got a liability to clean up because of that, you've sold those credits to another institution. And then you've got a number of things here called deferred credits, which are sort of more like deferred credits in financial accounting. There's things that are not recognized in the income statement yet, but will be recognized later, much like a deferred revenue. Okay, this is enforced here, as we'll see, because we want the income statement to honor the financial accounting realization principle. The difference between assets and liabilities is equal to stockholders' equity. You'll see here that's what's separated here is that which is due to Scope 1 emissions, which is the primary focus here, but there's also a line for Scope 2 emissions, but very, very much separated out, okay, in the in the balance sheet. And I'll talk more about that in the future, in a moment. The income statement, well, I'll just flash this one up to you. There are carbon credits, benefits you get for emissions, okay, and there's carbon contributions for putting carbon into the atmosphere, and that the net is the net zero carbon emission for the firm, broken down to scope 1 emissions and scope 2 emissions. Okay, and of course that balance sheet, that income statement, closes to the balance sheet in the shareholders' equity in the balance sheet, according to the principles of accrual accounting.
Stephen, Jonathan in the chat is asking, what is the role of reliability in these measurements?
Man, you're jumping ahead of me. Let me just say, and perhaps it's a good time to say this. What I'm giving here is a model accounting system, okay, which says these are the measurements we desire. This is the information we desire. Just as in the financial accounting system. But inevitably, we're going to run into measurement issues, okay? And that could be your reliability issue, or the feature, whether an asset, for example, is inestimable, okay, or a liability is inestimable, in which case it goes away. Having the form, so the liability criterion is going to be there, but the whole framework of the system maintains that you know that when that liability is applied and that goes away, this is the information you're losing, okay? So it's a benchmark for if, in fact, you had the measurements. In accounting, we know we can't always do the measurements. And that therefore reduces the informatives of the system, and that would be when, let's say, disclosure comes in as a substitute. Mm-hmm. But the same measurement principles we're going to think about as in financial accounting, and reliability is one of them. And I would, scope 3, for example, is typically deemed to be inestimable, mm-hmm. And it's not captured. Stefan, your hands up.
Yes. In fact, you just touched upon it. Can you go back one slide?
Yeah, if I can work my machine here. There you go. Yeah, there you go.
Okay. So, you early on sort of introduced the framework of the greenhouse gas protocol, the 3 scopes. Now here I'm seeing in your income statement, you get to a net carbon scope 1 contribution, and then there's also a scope 2 contribution. So does there seem to be sort of a border here in that scope 2 is included in your accounting system, but 3 is not, which of course naturally raises the question, everybody understands scope 2 is scope 3. It's just a particular category in scope 3.
It's a carve out. Yes.
That was carved out largely because people thought it was easier to track. So why do you sort of have part of the scope 3 emissions in your income statement here?
I think it's the same responses to Jonathan. The scope 3, other than the scope 2 carve out, is deemed to be inestimable. Okay, we could keep track of it if, in fact, we could estimate it. Certainly not certainly, but downstream, that seems to be the common opinion. Okay. Upstream, that probably is difficult. So it could be there. But I'm saying it's not going to be here because we've actually reached we cannot meet the accounting principle of being able to estimate it. Scope 2, you know better than I because you're much closer to this than I, is apparently deemed to be, you can get a number on it. So I'll keep track of that. But I want to say, and we'll come to this in a minute, this is not the main focus. Okay. It's only there for a particular incentive reason, and I'll come to that.
Okay. I mean, I'll just throw in the following comment. I think scope 2 is not only considered to some extent easier to track, it was also historically a very significant category of the indirect emissions that are in scope 3, and that's why people sort of kept separate track of it. But I think it speaks fundamentally to the notion and when you're designing a system here, which emissions is a company responsible for? Is it only responsible for what goes out its own chimney, or is it also responsible for the purchases of inputs? And then scope 2 is a particular type of input as opposed to a raw material that you're buying.
Yeah. Okay. Can I delay on that, because I'm going to deal with this issue very definitely in a few more
Okay.
slides.
Sure.
Okay.
Stephen, we have a number of questions.
Kyle, yes.
Hi, Stephen. I just have a more higher level question. How should I think of the balance sheet side, or rather the accumulation of these carbon credits, given that it seems like even the targets are set on things like net zero, on like the flow of emissions? I was wondering, can I view this accumulation of carbon contribution the same way as I view the financial value of the firm?
Yes, we'll come to that when we come to shareholders' equity, the stakeholders' equity. Stakeholders' equity is accumulation over time, okay? And that you easily see that because it's just the sum of all the periodic net carbon emissions that the firm has made. So it's tracking the as a position statement. It's telling us where the firm is now in terms of its accumulated emissions, okay? And as you track over time, how that gap is closing, how that's closing, or that's widening in terms of positive or negative. You'll see that coming too.
Paul Griffin has a question.
Paul, how are you?
Hi, Steve. How are you doing?
Not too bad, actually. Yeah.
Good. Hey, I just want to get to something that's really fundamental here. And that's the basis on which you establish the CO2 equivalence. If you look at the climate science, there's a whole bunch of mixed views on what that means. And there's actually a view that the GWP, which is called the global warming potential, those conversions are quite suspect these days, depending on how you measure a lot of the non-carbon contributors to the greenhouse gases. So one of the things that's going to come up when you apply something like this is that people are going to say you're building this on shaky science. So I'm wondering what your response to that is. When we build something on the dollar or the euro, most people would agree that that's a unit of exchange. But when you're building it on CO2 equivalents, there's a whole bunch of very diverse views on what that means. So how do you contend with that?
Well, let me put a disclaimer here. I don't know how to do that. Okay, and I'm not aware very much of the difficulties here. But we get back to the same reliability question. If in fact that is seen as engineering-wise or technically wise that number is a nonsense number, then we just revert to CO2 emissions. Okay. As I read it, and it's the first time I've heard of the difficulties from you, and thank you for that. As I read it, that they have this weighted in the GHG protocols.
But even with CO2, there's a debate on what time horizon you use for the GWP. It's way up in the 200 is very different from 100, very different from 20. So what are you going to use?
Yeah, well, we get back to Jonathan's question. If it's rubbish, it's rubbish. You can't bring garbage in, okay? So the whole thing falls apart. You're saying we can't get measurement. And that is, in my mind, that's problematical. The question how severe the measurements are. Maybe the technology will improve over time, okay? The engineering, the science will improve over time, but it all goes out. If you can't measure, you can't account. Stefan.
I would say in response to Paul's question, that's not something you or any accountant should take on. This is, an issue that, yes, climate science has grappled with, but for better or worse, all the other, if you want to call them alternative accounting system, have basically used the aggregators, the multipliers, to take other greenhouse gases and put it on an equivalent basis to CO2 itself. I don't think we have any any comparative advantage in solving that over the other. So to the extent that this is based on shaky science, all of it is based on shaky science.
Yeah, that's right. And so the disclosure. Okay.
There's just a couple of questions in the chat.
Okay.
Peter is asking, perhaps you're going to talk about this later. I would like some elaboration on the initiation assets and liabilities.
Okay, yes, I'll come to that in a minute. Okay, so if you defer. I mean, we're packing up the issues here, which is very, very good. And I'm glad you're seeing them. I'll tell you how I can say it now. Initiation assets. Well, we can't go back to when Exxon was first founded as what was a Standard Oil, whatever, in the 19th century. So that date is problematical. You could decide, understand it. Let's set it as the date of the Paris Accord. Let's set it as the date of when the firm first made its net zero promises. Okay, and so we can track them after that. I haven't got a good answer for that. Okay.
Yeah, the reason I
Or
asked,
you can set them to zero.
yeah, the reason I asked the question is, suppose we set them to zero, you basically start with a clean slate.
Yeah, that's
I
right.
think that's what it seems to me, you know, I'm not looking inside your head, but I'm going to say you have in mind. I mean, it seems to me that a company has future expected emissions. That's a liability. And so there's a sense in which those assets and liabilities could well reflect the expected emissions for the entity through to, for example, net zero. That's sort of where I'm coming from in asking the question.
Yeah. Well, the thing is, we also have a stock variable here, which is the accumulated net position in emissions, okay, which they're responsible for, okay?
But starting from zero or starting
We
from
start from zero, but
Okay.
what date is zero? Okay, so people say firms are actually responsible for cleaning up the damage to the atmosphere of what they've done in the past. Okay, so I don't know. I haven't got an answer to it.
Yeah, I don't want to belabor it, but let me just sort of jump on for a second to your carbon statement analysis, which I find to be really quite exciting.
Mm-hmm.
It seems to me that if we're trying to compare entity A with entity B, we're concerned about their future emissions possibilities.
Mm-hmm.
So starting with a clean slate's a good idea to me, unless we're going to hold them responsible for something they've done in the past, which doesn't seem all that likely.
Yeah. Okay. That's fair enough. That
could be the
another
initial
solution.
suggestion.
Okay, now to the shareholder. Okay, now just remind, this is a different stakeholder. We're going to have shareholder accounting for climate. Okay, which is the effect of climate on the shareholders. This is that fuzziness that seems to have a long time sorted out. Whether the SEC does not have a mandate to deal with general disclosures, only with shareholder disclosure, effect on shareholders. It's not about that. The IASB says they are only concerned about shareholder accounting. It's not that accounting. The shareholder here is, or let's call it the stakeholder, is the one to whom the accounting is directed and the one to whom the entity is responsible. Just like in shareholder accounting, it's the constituency to which the firm and its management are responsible. In my mind, in accounting design, you cannot get any traction unless you start defining to whom is the accounting going and in whose interest is it, okay? It's very clear in financial accounting, because we close to the shareholders' equity, that system is actually designed to report to shareholders, as long as the legal obligations. That doesn't mean, of course, it's not of interest to other constituents. So who is the equity holder here?
Stephen, there's a couple questions in the chat.
Yeah, let me just finish this thought. So, you know.
Okay, sure. Yeah,
We'll come back to it.
sure.
It's you and it's me. It's society at large. We're sitting here on this planet and we have interests in certain institutions, governments, firms, to enhance our well-being. Let's put it that way. And shareholder reporting, financial reporting is part of that. But we also have an interest. Hey, I'm worried about you young people. You've got to be perhaps worried about getting to retirement. Yes, the firm may generate some wealth for you, but you may not be able to breathe. So you have to be worried about that. And you have an interest in every entity to the extent to which how they're affecting your ultimate welfare. Okay, Natalie, the chats.
Okay, so there's a few things here. One, Alan had a comment, not a question, but he said that methane has a global warming potential, GWP in the GHG protocol of 29.8 times that of CO2. And the GHG protocol weights this over 100 years, but the life of methane is something like 20 years, according to UN papers, and the GWP in that time is estimated to be 80 times that of CO2.
Yeah, well, I've heard that, yes. It's actually quite potent, but it lasts only 10 years or 20 years or so. So, yeah.
And then Sudipta had a question. So water vapor also contributes to global warming. Are we going to track evaporation from all sources? And we really don't have good models for clouds and how much they cool the earth. And air pollution can also cool the earth. So will we account for that?
Anything that's going to affect anything from the shareholder, from the stakeholders' point of view, anything that's going to affect my life, okay, and your life, cause climate catastrophes, we're a bit interested in, okay? Now, if getting back to the issue, if you can't measure it, you can't measure it, all bets are off. It's not, and Stefan says, it's not my job, okay? It's over to someone else's job. And if you can't get it, hey, throw this out. Throw it all out.
The question is,
And mumble and do some greenwashing, okay?
No, it's just a question of when some things have both positive and negative effects, we need more than, say, people are talking about pumping sulfur dioxide into the atmosphere to induce cooling. Now that's pollutant, so it causes acid rain, but it also would reduce temperature. Accounting for only one side of it might also not be a good thing. That's the question.
Yep. That's a measurement issue. Yep. Okay. So of course,
There's
there's
a couple of other questions. I don't mean to bug you down here, but Jonathan is asking, in valuing assets, how does the timing of emission reductions fit in? Is carbon reduction in 2024 of the same value as future carbon reduction in 100 years?
Wait for a few more slides, will you please, Jonathan? We'll be onto that.
Okay. So Sudipta said proprietary theory versus entity theory. I'm not sure if Sudipta, do you want to enhance on that?
I mean, because we use GAAP, we're trying to please multiple constituencies, and proprietary theory is aimed at shareholders only, whereas entity theory is aimed at the firm as a whole, which includes other stakeholders. And a lot of accounting choices are split between entity and proprietary theory. So we don't have a pure shareholder theory of accounting in practice.
Well, we can talk about this. Hey, listen, the bottom line of the balance sheet is shareholders' equity. You close the earnings to shareholders. It's about updating shareholders' equity, period. Okay, that's what it's about. And this now is about updating stakeholders' interests. Of course, it can be, but you can have reporting to debt holders, but debt holders, reporting to debt holders, interest surely is not an expense. Interest is income. You have a different accounting because you've got a different constituency. So this entity thing is a very fuzzy concept in my mind. The firm is not responsible to anyone. Okay, so here are the regulatory. We have regulatory authorities. We talked about taxes before. Carbon taxing authorities may want to tax carbon. Well, they need information for that. And as I'll indicate, that they probably need a balance sheet as well as an income statement. Okay. And that's going to be important. I got to move on because I see the time's going here. So this whole perspective. Now, you've confused the terms now. This is we're accounting for an entity as responsible to stakeholders. It's entity accounting, okay, with responsibility to certain stakeholders. So this interprets that then in some sense, the assets are the shareholders' assets, okay? They're our assets. They're assets they're providing for us to reduce carbon. The liabilities are our liabilities because if they don't clean it up, we've got to clean it up, okay? Or we're going to have to stop breathing. So it comes to a different, and the difference between asset and liabilities then is our society's net position in carbon in this entity. Now, the entity can be, I'm using the word entity because we typically think of firms, but the entity can be, oh man, I can't see this. The entity can be anyone. It'd be a firm, a division of a firm, a government, or a government department. It could be the Defense Department. Okay. And as Peter mentioned before, the comparison with financial accounting and analysis there is very interesting because no, we don't want the Defense Department to have zero emissions because there's other benefits and there's a trade-off. Just as for an investor in a shareholder in an entity wants wealth generated, but is also concerned about carbon. So one of the advantages of this is these carbon statements are in the same layout and format as financial accounting. So, for example, I'm a young person. Let's hypothetically, I'm a young person who wants to save for retirement. I want to send my kids to college, and I'm interested in generating wealth. But I also want to breathe when I get to retirement. So there's trade-offs. And so this is one of the advantages of this that there is it's an entity accounting and a responsibility accounting to shareholders. So here's the responsibility accounting. Okay, it is responsibility accounting to the stakeholders. How is this entity, whether it be a firm, whether it be the Defense Department, whether it be a country, the US, China, whoever, I'm the one who's going to suffer, let's say. What are they doing for me? Okay. They make promises. Zero by 2050. I want an accounting system that actually tracks how they evolve over time and how they get to those promises, and whether they actually on those problems. I need an accounting. I can do that in terms of product accounting. That Stefan works on, but I can also do it in terms of here's my promise of what I'm going to do for you all, okay, by 2020. And so you have a discipline of problems. And so and as time evolves, you'll have a budget versus promise versus actual. But let's note, it's not just going to be in annual carbon emissions, it's going to be in the accumulated carbon emissions in stakeholders' equity over time. So stocks and flows important. And it reports assets.
Sorry.
Oh, hello, there you go, Gunther.
Hi, thank you very much for the very interesting presentation. Quick question here on your previous slide here. You keep coming back to saying that if you can't measure it, you simply omit it. Now, with carbon offsets, the common consensus right now is that it's almost, at least the way they're constructed today, it's very difficult to measure them in a way that they are reliable.
What's them
offsets there? Or carbon credits?
Oh, yes.
Presumably that you use these two terms interchangeably. Scope 2, there is some disagreement how reliably you can actually estimate them. Scope 2 is probably the highest. Scope 1, there's probably the highest agreement how to measure them. But then when you come back to your flow statement, are you essentially left with scope 1 in your income statement? Then to what extent differs your income statement from the current greenhouse gas protocol?
Yeah, I agree with this. This is the measurement problem again, okay? And various aspects have different measurement problems. As I said before, this is a framework that if I had the measurements, I'd like to fill up out these accounts, okay? But can I get the measurements to go in the accounts? I'm trying to demonstrate the features, the informational features, the incentive features of having this system, but you can't do it. You can't do it, and all bets are off. All we can do is babble about it. You can't have disclosures either if you can't trust the measurements. You just got to go for the babble. And accounting, well, the role of accounting is to cut through the babble, to get concrete, to get measurement up and running in an orderly system, which is a set of accounts. And that's what we're trying to do here. It may be, as time proceeds, given if you see the informational benefits of this system, working at this measurement, establishing standards boards or whatever, to get these things going, these things may improve. But yes. Stefan.
Okay, this may be the right time, since these issues of reliability, measurability, verifiability are increasingly creeping into the conversation here. So would you, I'll pose it as a question in the following way. As you're aware, there are quite a few companies that are now doing or implementing serious corporate carbon accounting systems in which they're basically tracking the carbon embodied in the products and services they sell. That's entirely a historical cost perspective. And you're trying to do this both on your own and with the help of your suppliers. But the idea being that we're trying to track the emissions that have actually been embodied, subject, of course, to allocation issues, in the products that we're selling. It seems to me you're going in a very different direction, if I understand it correctly, because you're going really in the direction you want to put on your balance sheet inherently assets in the sense that these are investments that have the potential or the promise to reduce emissions in the future relative to some benchmark.
Yep.
But you want to put those on your balance sheet. Aren't you thereby sort of really opening the door to the question of reliability, that this must by its very nature must be very subjective and based on information that would be almost impossible for an outside party to have?
Okay, you're quite right. Okay, this is not the I wouldn't say the historical emissions are free of measurement problems, but you're quite right. The assets here are what you're doing to reduce CO2 emissions in the future. So it's measured on the expected CO2 emissions in the future. So just as you said. Now, I think that's a very important attribute. You're not just judged on your current emissions, but what you're doing to reduce future emissions, which are going to affect me when I get to retirement. It deals with a timing problem before investing and the return on investment. Okay. Now that requires so for sake of a taxing organization, oh man, look at what you're emitting this period, and it may be you're emitting it because you're investing in emission reduction assets, and that emits emissions. Let's tax the bastards, okay? No, this says, well, hold it. There's a balance sheet here. You've got to take that into perspective. Now, in terms of settling up, there's an income statement to settle up against. You say, I'm going to reduce so many million tons of CO2 through this investment. In the end, there's a realization principle where you're going to settle up against your promises. And if, as you go ahead, you're not settling up, there's an impairment system, okay, that's laid on this. and your judge, oh, you made these promises, but you're not following up, following up on them. So that realization relative to expectation is a disciplining mechanism, which I think is a good feature of the system, because we got the realization principle in place here. You cannot book in the flow statement unrealized gains and losses, as you would do with fair value accounting. Okay, you only book realize, and that realize is the basis for settling up against your asset numbers. And who knows, it may introduce conservatism and all sorts of things. That's certainly a discipline. Gunther.
Yeah, sorry for just jumping in here. Can I just ask a clarifying question? Namely, do I understand correctly that your unit of measurement here is a sort of a calculation of emission reductions? So that will be calculated as actual emissions versus emissions of what they would have been if some activity would not have occurred. So by construction, it's a calculation against a hypothetical baseline. Is that how you're approaching it?
I think you're talking about the income statement, okay, the flow number. The flow number is the actual net emissions this period. Now,
and what is then on the like the assets in the stocks in the balance sheet?
Sorry?
What are then the unit of measurement?
The assets in the balance sheet are the
assets?
expected emission. Now, we probably won't have time for this. I'll go back to the detail of the income statement. I flashed that up in front of you, okay, which had a number of line items. There is a grossing up number here. So when in fact you reduce emissions in the balance sheet, you reduce the asset, okay, because it's depreciated. You reduce the corresponding liability, but no effect on equity, okay, for the realization principle. But you have a grossing up to say, okay, this is what it would have been had I not had the technology. So in the income statement, you can see what has been the periodic effect of that investment of that asset, which then becomes the basis of the how much the asset would have reduced emissions by this period, and the extent to which that's not up to projection, then you're going to have a remeasurement of the asset. That is, you're going to have an impairment.
Stephen, there are a couple of comments in the chat, but I want to make sure there's just under 10 minutes left. So
okay. I told you at the beginning I probably don't need the 5 minutes at the end, but I'm going to grab them. Okay.
Okay. All right.
So maybe people put in the chat box and we can send it on to me, and I can reply. Unless Natalie, you deem these are questions that are very important for a wider audience to hear the answer to.
Well, I think there's a couple that are seconded, so maybe I'll read that one. In a way similar to so this was from Jonathan. In a way similar to the way we view the importance of line items in the income statement and financial accounting, I would think we'd care a great deal about how a reduction in net emissions was achieved. Is that a key component of this? I'd like to hear more about how the budgeting component of your systems lines up with financial accounting.
Yeah. Well, that's if you go back to the template for the income statement, that's there. There's a grossing up to what the emissions would have been had you not had these assets to reduce the emission. Okay, and that gives you the basis of the comparison with expected versus actual. And if they don't match out, then you have to have an impairment.
Okay, and then there's another question. What happens when you're forced to produce products that consumers don't want to buy? That consumers don't want to buy, for example, EVs? Is that right, Stephen? Okay, yeah.
Oh, this is not my problem. If society, if the government is forcing you to do this, then oh man, I don't know. If the government is forcing, no, I haven't thought of that one. No, I haven't. Okay, so it's responsibility accounting. So this is what we said. No, I'm going to go forward here, Stephen. That's right. And then, of course, in the stocks and flows now, we just don't have the periodic emissions. We have the accumulated emissions from the initiation date, whatever that may be, Peter. It says, where are we now? And of course, we can track that over time. We can track that over time to see to what extent, yes, they're reducing periodic emissions, but to what extent this, since initiation, this stock gap is being closed. Okay, so they're contributing not just to reducing periodic, but reducing the gap. Aggregation over time. I'm speeding up in here. It's going to be flashcard time here, guys. Within reports, we've got aggregation of like numbers to subtotals, which then aggregate to bottom line totals. Okay. I read some, I think often Wagenhoff has a paper, you know, there's something like hundreds and hundreds of different metrics and aggregation metrics. Okay. This has a very specific aggregation to it. There's double entry, and the double entry, of course, this has the property of, first of all, there's a control feature. You can't go outside the bounds of double entry. But secondly, you can't think about liabilities without the assets, just like you can't think about debt without the assets to back it up. You've got to think about liabilities to debt. That's one of the financial statement I was going to. Okay, now this point here, we're running out of time here. Recognition. Basically, this is only about it's scope 1 reporting. It's only about the emissions for which the entity is directly responsible. Okay. As we'll see in a minute, that's important for aggregation. This is what you're responsible for. This is the responsibility reporting for scope 1. What are you doing to me, and how are you helping me as a stakeholder? The only trouble is that there's a problem whereby I can get out of this by shifting. Okay, let's say rather than have my own electricity generating plant, I should shift it back to scope 2. Okay, and so I can game the system. So that's the reason the only reason here in a responsibility reporting framework why this scope 2 is included. You're reducing scope 1, but you're increasing scope 2. You're gaming the system. Scope 3 could be incorporated, but as a separate line item. I must say this scope 2 line item is just to monitor them. Okay, they're not playing these tricks. Scope 3 could be there, but that we've got our severe measurement problems in that case. Oh, man, I've gone the wrong way again. Okay, now these financial statements can be allowed out in pro forma. Here they are now. Here's my management's pro forma reporting to you, the stakeholders, of what it's going to look like in the future. I'm laying out, here's my strategy for the future. I'm telling you, this is what it's going to look like. That's very helpful. I can think of what are they going to look like in the future. And of course, that then brings discipline to the whole thing. Means that, you know, it establishes the milestones every year to get their zero net emissions, which then the actuals versus the budget, or the pro forma versus the budget can be reported every year. That's going to be a check on this on the Babel. Finally, I think it's consolidation accounting. Given it's only scope 1, it can be consolidated. I can't consolidate scope 2 because I'm double counting. So I can account for responsible accounting for a division. I can aggregate them within a firm. I can take firms and aggregate within industry. Well, apparently chemicals, cement, agriculture are supposed to be emitters. I can aggregate to say, okay, what are the industry contributions here? Okay. I can aggregate within governments. I can aggregate within companies. In principle, okay, in principle. And I think that's a very nice feature of the of the system. And then, of course, the next final thing I think is it's a parallel to financial statement analysis, which Peter said he likes a lot, and I do too. That actually now with these line items, you can do comparisons of the measures of line items to get certain ratios, okay, and certain measures of performance. So, for example, and then we can also do a comparative financial statement with our financial accounting. So the accounting, we may be interested in getting wealth from this country, investing in this company, but I want to see what the profits are, but I want to see how much carbon is being generated to damage me when I try to consume that wealth in retirement. So absolute's a challenge, and so we get some relative assessment and the trade-offs between generating of wealth in financial accounting and generating carbon. Those trade-offs can be made. Okay, I've got to close off here now. You got a cool time, haven't you, Natalie? Because there's a lot of accounting detail here. It's basically just debits and credits. There's a whole list of bullet points in the paper which are transactions to show what would be the debits and the credits. Okay, and some examples. I'm just quoting examples of a financial statement analysis. We have return on equity in financial accounting. Well, I can have return on the stakeholders' book value. Here's what you've got in this period relative to the accumulated balance, okay? And you've got a big accumulated balance, negative, and you're generating more. You look a lot worse than a big positive balance, and you're generating positive flows. So you can do this financial statement analysis. You can do debt equity, equivalent to debt equity ratios, and so on and so forth. So that's it. I'll get out of your way. Just one thing. If you have a transaction or a situation in mind, and you're not sure how the accounting would handle it, will you please email me and say, hey, Penman, how would you handle this one? Okay? Because I'm really interested in what it handles and what it can't handle. There's some things that I'm not quite sure about that it covers, okay? But you're very helpful to me if you actually email me and say, how would you deal with this situation? And if I have to say I can't, then that's a deficiency of the system. Thank you all very much for your attention.
Thanks, Steve.
Thank you. And Steve, there are a couple of comments in the chat that I can forward to you as well.
Okay, thank you very much.
Thank you, Steve. Good to see you again.
Yeah, thank